Welcome. You're watching the Mutual Fund Show. I'm Tamanna Inamdar. Now, the buzz is all about exit polls, election results, and of course, the kind of response we have seen from the markets to the exit polls. Suffice to say, a lot of portfolios and mutual fund investments looking very healthy today. The question is that even as every retail investor, fund manager is trying to understand what next in the market, what does that advice say for mutual fund holders? And that's what we're trying to break up today. So we've done a couple of things. We've tried to tell you what have been the best performing funds in the last 5 years. And remember, post-election, so on the 5th of June, we'll have a very special mutual fund episode as well, talking about what the next 5 years of your portfolio and investments should look like. Now, to speak more on the topic today, we're joined by Rishabh Desai, founder of Rupee with Rishabh Investment Services, and Santosh Joseph, founder of Germinate Investor Services. Welcome to both of you, and thank you so much for speaking with us today on the show. I was quite excited about this topic, Rishabh, and I'll come to you first, because looking at things in that time block, if I were to look at just the mutual fund industry and the kind of penetration of mutual fund investments over the last 5 years, if I were to look at 2019 and 2024, there is a huge jump in the number of investors who have now put their faith in mutual fund, the number of AUMs, the amount of AUMs, SIPs which have come in, folios which have been opened. So today this becomes a very pertinent question, that what is the election play?
Tamanna, first of all, thanks so much for having me on the show. See, we are absolutely living in very unprecedented times, very exciting times. And of course, as you correctly mentioned, that exit polls have clearly given an clear indication towards the BJP-led NDA government, turning out to be a full majority for the third term. See, this clearly indicates that there is going to be strong economic growth. Reforms are going to be made with absolute strength and precision. And of course, policy momentum is going to also continue as the way it is. So this is going to be focused on three things. One is the capital expenditure, manufacturing, and infra development. As you correctly put that over the past 5 years, that yes, mutual fund has grown substantially. The penetration in the equity also has grown quite a lot. But let's not forget, out of 140 crore population, we still remain very much underpenetrated, Tamanna. See, we are not even 10% penetration in terms of mutual funds, and we are not even 10% penetration in terms of in penetration in equity, right? Although we have seen a good jump, there has been around 55 lakh crore of AUM in the mutual fund industry, and 20,000 crore of monthly SIP is flowing into the mutual fund industry. But I feel we have a very, very long way to go. This is just the beginning. But this, in today, what just we witnessed in the market is more of a sentimental driven spike, what we saw. Let's not forget the fact that valuations still remain very expensive today. Mid and small caps are definitely very expensive compared to large cap. Large caps remain comparatively reasonably priced today. So I think we have a very long way to go, but investors should not get carried away by these sentimental spikes.
No, that's fine. Investors should definitely not get carried away by the sentiment. I mean, but the fact is that people have found a way to increase value, and we were just showing some of the best performing funds in the small and mid cap segments. You have seen funds give returns of over 300% in the last 5 years, now assuming that you stayed put in them. So wealth has been created. The question is, even when you're talking about valuations, Rishabh, those who are continuing with their SIPs have been in for a while, are consistently coming in. What about investors who are now looking at larger allocations, perhaps, into mutual funds? What would be your advice for them?
Tamanna, people who are looking to invest lump sum today, definitely they should not venture into mid and small caps. Mid and small caps should be avoided at all times at this point of time. I see value in three, four pockets, Tamanna. One is the large cap segment, where valuations are comparatively reasonably priced versus mid and small caps. Second is I see immense opportunity in growth strategy, because growth strategy has underperformed over the past 3 years. Over the past 3 years, value as a strategy give phenomenal returns. So I see value in growth oriented products. Third is I see opportunity in hybrid products, which is the dynamic asset allocation funds, which is a combination of equity and debt both. And I pulled out the portfolios of the dynamic asset allocation funds, which stand at around the equity side, stand at around 75% large caps, right? And the debt yields at the peak range. I think dynamic asset allocation funds are today in a very sweet spot. So one is pure large cap. Second is growth oriented products, and third is dynamic asset allocation funds. These are the three categories I see immense upside opportunity in the next 2 to 3 years.
Okay. So there are still major upsides in the next few years. Santosh Joseph is joining in. Santosh, I think one question that a lot of people would have is this the time to sort of front load and make in some lump sum investments? Or should we wait till all of this frenzy and excitement about election results dies down? If you have these cash allocations to make, of course, those who are already in SIPs, I assume your advice would be to continue as is.
Hi, Tamanna. So, yes, the guys who are on the sidelines or missed out participating so far, it's a great opportunity for them to enter the markets even now. Now, though today is an exciting day, Monday's become a green day with so much of positive and upsides in the market already visible just by the exit polls, and we still have the election outcome to come. But for the people who are waiting for this big event to get over or get done with, today have a clear indication for another 5 years. So therefore, this 2%, 3% that's just moved up now, or the last 20, 30% in the last year or so, should not be a deterrent saying that they came late to the party. Even today, if you're an investor who was considering to invest, there's ample upside, plenty of opportunities, plenty of pockets of spots that you can invest in the markets even today to begin your journey. Now, for the people who've been sticking to their investments or been investing for the last 1 or 2 years, it is a great validation that they did right by one, investing, number two, not pulling out, number three, continuing to invest through SIPs. I think all of them would be vindicated and they would be, there's a good pat on their back. But for the people who missed out the whole story, you have a great opportunity even now to begin, because you still have the whole purpose of the election was to bring clarity and a long runway in place for you. So now the runway is in place. The big event is kind of done with right now. I think there is enough headroom, even if you're starting today, to make money and make money in a meaningful sense.
Where are those pockets, Santosh? Because then that's the next interesting question. If I just look simply at the kind of moves we've seen, and there's a broad, a broad brush sort of up move in the markets, but PSUs, defense, infra, and we've seen these thematic funds also do very well in terms of interest of investors in the last couple of years. Would you double down on these kind of themes? Small, mid, large, what would be your best bet?
So you're right. In the last year and a half, a lot of thematics have done phenomenally well. And mid and small cap, everyone knows the story that it's done great returns for the investors. But I think now I'd be a little boring with my approach to say that rather than pin down on large, mid, or small, I'll go with all the three. My first choice in this category would be the multi-cap. I feel that in this given context, it is the most underrated category in the whole mutual fund space, which is the multi-cap, where you have a good combination of almost 40-50% in large cap and a nice balance of mid and small cap. Now, one cannot ignore in such a structurally bullish economy like India to say that smaller mid caps, I will not stay because the valuations are high, because these high valuations can even become greater. But if you get into a multi-cap, and if you want to be a little more conservative, get into a flexi-cap, there is huge opportunity there to play the large caps which are available at good valuations, mid and small caps, selectively have a portion in your portfolio, selectively nibble some of the best names which still have a massive upside pending in them. So I think multi-caps is my first go-to. Flexi-cap with a little more generic exposure, higher to large cap, still makes a lot of sense. I would not stay away from the market, but I'd also be slightly less receptive towards any thematic or standalone large cap or mid cap.
I'm going to ask both of you for your top funds because that's the investors will want a clear takeaway today on what to look at now, whether they're SIPs, lump sums, etc. If someone is coming in with a fresh allocation right now, Rishabh, what would that breakup look like and what would be your top funds?
Tamanna, I think any uh, portfolio, while creating any portfolio, one should stick with their goal, their risk appetite, time horizon, and asset allocation, right? But if you ask me if I have a long-term time horizon, say 10 years or so, and if someone is venturing into the equity segment, I think around 50-60%, I would put my money in the flexi cap category, 20-25% into pure mid caps and 20-25% into pure small caps. I think that will be a good combination because we have observed that flexi caps have always been a little more tilted towards large caps. So in this way, see, if you create a 50-60 portfolio or towards the flexi caps, you are automatically getting anywhere between 40 to 50% into large caps, right? So I think 50-60 towards large caps and the rest can be divided into mid and small caps is something what I would create for myself.
What about debt? Debt funds, would you be looking at them now in new light, Rishabh?
Tamanna, I think this is a very golden period for the debt market because now, interest rates are definitely in their peak range, but also India has come under the JP Morgan bond index and the Bloomberg emerging bond index, right? So over the next 2 to 3 years, 20 to $40 billion will be pumped into the bond market. So I think I would go towards the corporate bond funds and tactical allocation towards GSEC. This is something what I would create in the debt segment.
Santosh, that question to you. Let me add, what would be the equity debt split right now and what would be your top fund picks?
Okay, let's go the other way. So first and foremost, good question. We always still need to have a debt and equity mix because it's very common for investors to think in very buoyant markets like this that they don't need debt. And especially when you look at the last year or two where equities have massively outperformed and fixed income being very benign, one would think that they could skip debt altogether. But I think the question itself is well placed that you need debt into the portfolio. And within debt, I would play it as a combination of that 3-year average maturity with a decent holding of maybe corporate bonds and a mix of both corporate and government bonds. Clearly, the biggest upside is there in the government bonds. When you play the 5 to 7 year modified duration, I think you're getting the best of both worlds. In fact, like Rishabh said, there are many levers even for a positive fixed income yield benefit for the investors in the next 1 or 2 years. So while you are cushioning your portfolio with some amount of fixed income, maybe 20-30% or maybe up to 40% for a conservative investor, there is now a situation in place where fixed income will give you better than what it did in the last 2 or maybe even 3 years. There is an opportunity there. And even the quality of fixed income, you don't have to go down the order between good corporate bonds and GSECs. There's enough of money to be made. Now, coming back to equities. Now, I think my favorite would still be the multi-caps simply because by definition, a multi-cap should have a minimum of 25% in large cap, mid cap and small cap. And therefore, the rationalization will happen in about 40-50% in large cap and rest in mid and small. It gives you a beautiful opportunity to play this massive opportunity as India economy blooms from a global perspective. Now, coming back to what are the funds that we like, I think traditionally multi-cap and flexi-cap funds are easy to select because if you select the ones which have a 1 or 2 year track record and even a reasonable size of fund from a good fund house, you have the winners over there. My, I have favorites of flexi-cap with, on the multi-cap side, I like the Nippon multi-cap. On the flexi-cap side, I like the 361 flexi-cap. I also like the HDFC flexi-cap, tried and tested. And on the balanced advantage, guys like HDFC and ICICI have got a phenomenal track record, and even their equity ratios right now give you a straightaway fix into debt and equity, large cap and mid cap, small cap, all fixed. So depending on what kind of investors listening to us, if you choose a BAF, you got debt, you got equity, you got large cap, you got mid cap fixed. But if you want to build your portfolio alone, then you normally do a 60-70 in equity and then go balance into fixed income.
This is the part of the show where we take your queries. So let's start with those. Now, the first query is from Gopal, who wants to know about his retirement fund. He is 47 years old and says, I want to add a mid and small cap fund to my portfolio and invest 20,000 rupees in the funds. Can you recommend a few schemes? He's also given details of his current investments via SIP, which includes the PPFAS FlexiCap Fund, Franklin India, FlexiCap and Kotak Large and Mid Cap. So Rishabh, already 2 FlexiCaps are there, large and mid cap. I would say a well spread out kind of a portfolio. Now, where should the additional 20,000 rupees go? He's identified small cap funds, mid and small cap funds as the target.
Tamanna, first of all, the portfolio looks very good. Fund selection is great. Portfolio is, of course, more tilted towards large caps. So I think don't add too many funds in the portfolio. I would just add one additional fund, which is the Mirai Asset Nifty Mid and Small Cap 400 Momentum Quality 100 Fund of Fund, which is a combination of both mid and small cap. I think one passive fund, one smart beta fund, and from the data what we saw, it looks quite nice. I think adding just one fund, which is a mid and small cap 400 momentum index fund, would do the job. Don't add too many funds. I think he'll be very well sorted.
The additional 20,000 rupees all goes in this one fund that you've mentioned?
Absolutely.
Okay. Santosh, what is your advice? Santosh, can you hear me? Okay, we seem to have lost the feed with him. We'll try and get him back on. Shivvardan Reddy has the next query for us. He is 25 years old and his goal is retirement fund. Good on you, first of all, Shivvardan, to think about your retirement fund at age 25. He has an investment period of 20 plus years, of course, with time on his side, and a salary of 40,000 rupees per month. He asks if he has chosen the right schemes and has talked about all of those schemes. There's an SBI multi-cap fund, regular growth, Kotak Equity Opportunities Fund, Franklin India Flexi Cap Fund as well. All of them are growth schemes. First of all, Rishabh, I mean, kudos to our viewer who is thinking already about retirement fund and investments right at the get-go, says he wants to add more and is asking for a review of the schemes that have been invested in so far.
Tamanna, absolutely. First of all, congratulations to him that 25 years he's thinking about retirement, which is around 60, 65 years, of age. All of the funds are very good in quality, backed by great AMCs and teams and fund managers. I don't see any issue over there. You can hold on to these funds the exact way it is. Just one small recommendation is add Nippon India multi-cap fund from a diversification point of view. I think including Nippon India multi-cap will have a good balance between large, mid, and small caps. I think having little more tilt towards mid and small cap is very important as per his age, because historically we have seen that mid and small caps have always given higher returns compared to large caps. So I think adding Nippon India multi-cap fund would do the job. And just one more thing that, as and when, your salary increases, don't forget to step up your SIP amount by 10 to 20%. I think a substantial amount of wealth will be created over the next 30, 40 years.
Santosh, we've got you back on the line, and I wanted you to field this query from our 25-year-old viewer who's looking at a retirement fund. He's named his funds, and there are 3 of them, and wants a review whether this is the right choice.
No, absolutely the right choice, and I agree with Rishabh that it's great that at this age he's taken it upon himself to invest and got a good mix of funds to go with, and this is probably the ideal set at that age to begin with. And I'd again concur with Rishabh to say that at this age, this salary, this SIP is just the perfect mix. As you progress in your career, your salary is going to grow, and keep the investment in line with the growth of your salary, so that you start making this entire wealth building exercise more meaningful. Now, I would go on to say that as your salary increases, you can also increase a little bit of your risk appetite by adding maybe 1 or 2 SIPs into mid cap and small cap. And even after that, as your salary progresses, to add a little bit of international exposure, because you've got a long runway. And if you're 25, and I'm suggesting that you have 20, 30, or maybe even 40-year career, you'll add more money to the investments. You don't need to necessarily add more funds, but you can rationalize the number of funds, but stick to it. Don't pull out money when you have the first need. You'll do well.
Yeah, I think that's the big one. Stick to it and don't pull out money when you have the first need. Ramesh is the next query, 35 years old, also wants to build a retirement fund, and I really found this query interesting. He asked, should I reduce my exposure to EPF and add more to small cap funds, which is 75% of his portfolio, until I turn 50 and then move the funds back to large caps? Also, Axis funds are underperforming against the category. Should I stay invested or move to another fund? He's also added his list of investments, which includes the Axis Blue Chip, Mid Cap, all of them actually, Axis Small. So 3 Axis funds, then there's PPFAS Flexi, Mirai, as well, and his EPF fund as well. So the basic question, Rishabh, and then we'll come to the second part, of course. The basic question is that should he reduce his exposure to EPF and add more to the small cap fund category?
Tamanna, what I understand from the question is that he's investing 11,000 rupees per month in the PF product. I think continue the way it is. Maybe if he doesn't want to step up, that's fine. I would not recommend going beyond 1,50,000 per financial year. Which helps give tax benefits in the PF when you retire. So don't go overboard in PF, but have a sufficient PF of 1,50,000 rupees per financial year. This is something what I would recommend. Coming to his portfolio is, too many Axis funds. It is very important to not have concentration risk towards one particular AMC, because currently, yes, Axis is underperforming. So probably 50% or more than 50% of his portfolio would be in underperformance at this point of time. Have different funds from different AMCs to avoid underperformance and overlap risk. I think overall he's from category wise, he's done a good job. Blue chip, mid cap, small cap, flexi cap, and emerging blue chip. I think just keep Axis small cap fund, right? And you can switch Axis blue chip into another large cap fund and Axis mid cap into another AMC mid cap fund. I think overall he'll be very well sorted.
Okay, very quickly, Santosh, because we're almost out of time. Just the basic query. PPF, I assume it's PPF because EPF, you don't really have a choice beyond a point. PPF versus a small cap fund and then switching that to a large cap fund.
No, I think the primary thing that you got to sort out is that ideal mix of debt and equity. So I think you should continue the PPF because it's important. We cannot, in these exuberant times, get carried away. One, into overexposure to equity, and second, also overexposure to small cap. It's definitely not recommended. I know the times are such that small and mid caps have significant outperformance to broader markets, and therefore there is this affinity to think that if I move to small cap, I will reach my goals earlier or I'll increase my overall net worth. Avoid those kind of knee-jerk reactions in a buoyant market like this. I prefer keeping a combination of both the PF bit and even equity bit. Continue this portfolio with minor tweaks. And if you're so aggressive or you want more equity exposure, increase it in the flexi or the multi-cap category, like I explained earlier, so that you get a good exposure to the markets and good outperformance to the markets in general.
All right. That's all the time we have today. But Rishabh and Santosh, thank you so much for joining us on the show. To all our viewers, tomorrow is going to be a whole day of election and markets coverage. Don't forget to tune in for that on NDTV Profit, and we'll be back on the 5th of June on the Mutual Fund Show at the same time, same place, to talk about what the next 5 years of your investment should look like. For now, that's a wrap from me, but stay tuned. A lot more coming up on the other side on NDTV Profit.